And I should just back into this a little bit. So Zoltan Pozsar, a former advisor to the U.S. Treasury Department, now a strategist at Credit Suisse, and he's been writing a lot about the repo market. In fact, just 4 or so weeks before we had that Repo Madness incident, and this was where short-term borrowing rates in the money market suddenly surged. 4 weeks before that actually happened, Zoltan had been writing, again, some eerily prophetic things. Like he actually wrote in a piece of August research that the funding pressures that Credit Suisse is forecasting include overnight general collateral repo rates drifting outside the Fed's target band. And that is exactly what happened in September.
I remember, and I'm not just saying this because he's here in studio and we're about to talk to him, but I remember even before I noticed, I remember the day that the rates shot up, I didn't even notice it until a trader at a bank IB'd me on my Bloomberg and said, "Are you watching what's going on in the repo market? It's exactly what Zoltan predicted." And that was the first. Then I went and looked. That was my first indication that something was amiss. Someone alerting me in that way. That's how closely his research is tied to what we've seen in people's minds in the market.
Yeah, Zoltan is at one with the repo market and money market crunches. Again, just to provide a bit of background, so what we actually saw on that day was repo rates, the cost basically of making secured overnight collateralized loans. Those repo rates jumped from, I think it was about 2% to something like 10%. And lots of people had talked about the possibility of a funding squeeze, especially around quarter ends, which is where we get these sort of traditional crunch points in the financial systems because big banks have to pull back on their repo financing ahead of quarterly liquidity requirements and other regulations. But far, far fewer people had expected it to happen at this sort of random juncture in time, this slightly random week in September. So again, it was really unusual. It spooked quite a few people, and everyone immediately said, we must speak to Zoltan Pozsar.
Absolutely. And it's important to remember, too, that when people see this stuff, everyone has sort of still, after all these years, post-crisis PTSD, and you look at bank overnight funding costs, and they're soaring from 2% to 10% in a day. And of course, a big debate immediately broke out. Is this something strictly about financial market plumbing, or is there something deeper and more systemic at play that sort of speaks to some inherent frailty of the financial system? And obviously, things have quieted down quite a bit since then. But nonetheless, I think people are still unsettled, and no one really knows what the ultimate fix is going to be. The Fed has applied temporary fixes, greater expanding its supply of reserves or overnight operations to satisfy the bank demand for this short-term liquidity. But no one really knows where this is ultimately headed, it seems.
Right. So I'd say it's actually debatable whether or not things have calmed down in the repo market. But why don't we just jump straight into the discussion with Zoltan, and we'll be able to get into all of these really, really interesting and fascinating questions.
Let's do it.
Zoltan Pozsar, thank you so much for coming on yet again.
Very nice to be here.
So let's start off with that week in September. Presumably you're sat in Credit Suisse, maybe watching overnight market rates as you do. What are you thinking when you start to see the repo rate jump like it did?
Well, actually, I wasn't in Credit Suisse the day of this happening. I was actually traveling down to DC to see some clients with one of our sales guys. And, we saw the markets open up and we were chatting in a cafe cars. And okay, well, Monday wasn't good. Tuesday is shaping up to be worse. And I'm not kidding, 5 minutes into that train ride, the train broke down. And we were basically told to have to get off the train and there's going to be another train coming. You had to call the client that, sir, but the train is running late. And then the Fed announced the repo operations. But then the Fed was late with the first operation due to technical glitches. And I looked at Phil, the sales guy, and I told him, look, the country is funding itself overnight in the repo market. The trains don't run. an event can even do an operation on time. It has to be a joke of some sorts. But the September blowout was, took many people by surprise. I think a lot of people focus on what happened and they kind of look for the trigger that triggered it on that day. And I think that's actually the wrong question and the wrong thing to focus on. The September blowout in the repo market was a long time in the making. What it had to do with is basically taper. And taper was just very slow burning process where, the Fed took more and more reserves out of the system.
Right.
And when the system ran out of liquidity, which in this specific case means, the reserves that the system can settle with.
Right.
The moment you ran out of those reserves, the repo market seized up. So this was basically a $600 billion process, which is how much the Fed tapered. The one thing that was very important to watch is basically look at who are the most reserves-rich banks.
Right.
How much reserves they have lost as the Fed was tapering the balance sheet. And what is the body language of bank CEOs and bank CFOs, and when you listen to them during earnings calls as to what is the minimum number of reserves that they need to hold from a business perspective. The largest bank that held the most amount of reserves, JP Morgan, during this taper process has gone from having $350 billion of reserves at the Fed to $120 billion as of the end of the second quarter of this year. And so when you saw that number, you knew that the bank that was always the lender of next to last resort in the repo market basically ran out of money.
So let's back up just for people that maybe aren't as familiar with some of the terminology or even the structure of the banking system in the hopes that they can understand this topic. When you or I have our money held at a bank, we have a deposit. The reserves are essentially where banks deposit their money at the Fed.
Mm-hmm.
And there's a fixed amount of reserves available.
Mm-hmm.
And that greatly expanded during the financial crisis thanks to quantitative easing, essentially the Fed going out and buying safe assets like treasuries or mortgage-backed securities with reserves. And then it was starting to shrink them as part of the taper process. And essentially what happened, or what's going on, is the shrinking of the balance sheet collided with regulatory requirements on banks to hold a certain amount of reserves at the Fed. So explain this sort of collision of arguably different arms of the government imposing different demands on the banking system.
So let's start with two observations. Number one, the payment system used to be, it no longer is. It used to be a credit system, which basically means that pre-crisis, when banks make payments between each other, when they transfer money from one bank's reserve account to another bank's reserve account, it used to be the case that banks could go into a negative balance in their reserve accounts at the Fed. So that's the whole intraday credit provision that the Fed used to provide to the system, which basically ensured that payments between banks never bounce. Okay, if there's not enough money in your reserve account, the Fed is going to put in the right amount of money so that payments can settle. And then that intraday credit provision by the Fed gets pushed into the overnight markets. It used to be the overnight Fed funds market, and that's the way the banks settled those claims at night. Post-crisis and post-Basel III, there is no bank that is ever going to use intraday credit from the Fed, because if you were to use intraday credit, it means that you are in severe breach of your liquidity coverage ratio, all your intraday liquidity requirements and all that stuff. So quite literally, post-Basel III, the system settles with the amount of reserves that are in the system. So there's nobody who's taking cash from the Fed on the margin. Then you look at the amount of reserves that are in the system, the distribution of those reserves is not equal. Some banks hold more, some banks hold less. But basically the banks that have the abundance of reserves, the reserves-rich banks, they are the ones that are lending into the system's settlement process on the margin. So in English, you went from the Fed adding liquidity into the system on the margin so that payments can settle to, and this is no secret, because I've been writing about this all the time, to JP Morgan basically using its HQLA portfolio to take their excess liquidity.
That's
and
high quality liquid assets.
high quality liquid assets, again, most of which 2 years ago was reserves, taking that money and lending it into the repo market or whichever corner of the funding market such that payments can happen. Okay. So basically, you went from the Fed providing intraday liquidity in the system to JP Morgan and other reserve rich banks. But again, JP Morgan is the largest example, providing intraday credit in the system on the margin. So what has happened is that as you tapered the balance sheet, you basically took reserves away from the system. Quite literally, you basically forced these large reserves rich banks to trade out of reserves. And there's collateral coming in, cash being taken out. On top of it, the Fed is basically cutting the interest on reserves rate, trying to encourage all these reserve rich banks to let go of their reserves and reverse in more collateral by treasuries. And by that process, they are forcing a redistribution of reserves across the system. But as they were forcing that change, they basically flattened the distribution of reserves. They basically forced the large bank to spend their reserves such that repo trades normal on any given day. But then basically the flip side of that was that they exposed the system to very bad days in the repo market, on tough days when a lot of money has to move. We'll come back to that in a second, and on quarter ends and on year ends.
So a lot of people, just on the reserve point then, Zoltan, a lot of people have been debating the language around this. Is it a scarcity of bank reserves or a shortage? And why does the difference between the two actually matter? I
don't think there's a difference. I mean, it's a shortage. Basically, what I'm saying is that the system ran out of tokens to settle with, right? Because, again, back to the earlier point, the Fed was always ready in the past to add reserves into the system on the margin intraday as needed. Okay, so it was never possible to run out of reserves. But in this regime where the Fed had X amount of reserves in the system and nobody is going to take credit from the Fed, the system literally settles with the amount of reserves that are in the system. So if the bank that has the access and is lending into the system on the margin runs out of that money, runs out of reserves, the system literally seizes up because you run out of tokens.
What was the regulatory logic? As you mentioned, the Basel III requirements, what is the regulatory logic of no longer wanting the banks to be able to essentially have overdraft capabilities or use overdraft capabilities at the Fed?
I don't think that there's a piece of regulation that says, don't take it, or the Fed never said that I will never give it. I think it's just, if every bank has to, like the LCR, for example, the liquidity coverage ratio, tells that every bank has to pre-fund 30 days worth of outflows. Right. Okay, so every bank is going to be 30 days pre-funded. Okay, so no one is going to be in the funding markets to kind of get the liquidity to be able to settle. Okay, and this is actually a very important question you're asking, right? So the banks don't have a liquidity problem here, right? All that has happened is that the banks have been the marginal lenders into the repo market. So the entities that ended up with a liquidity problem were the dealers. But basically for the past year, it were the banks that were the marginal lenders in the repo market. But the banks are only going to lend into the repo market on the margin until they reach a limit in terms of how much reserves they have to hold at the Fed and below which they are unwilling to go. Okay, so this was basically a liquidity problem for the dealer community.
Okay.
And the problem at a higher level was that the banks, despite having the liquidity, were unable to lend more into the repo market because if they were to be lending more, they would breach their intraday liquidity requirements. It's just one of those unintended consequences where it's just one of the unintended consequences of the rules where everybody basically wants to show, how much liquidity they have to the Fed, and they are unwilling to go below that because then there is regulatory scrutiny to pay.
So just to step back for a second, because this question comes up quite a lot, but if you're not in the money markets, sort of in the weeds of a lot of this, why should you care about what happened to the repo market in September? And I mentioned, for instance, the effective federal funds rate getting pulled up along with repo rates. Is that the big sort of takeaway from this, that the Fed sort of briefly lost control of money market rates or monetary policy or however you want to put it.
No. I think it's something far bigger. So why does this matter? It's an overnight trade.
Yeah. I tweeted, by the way, I said, what should we ask Zoltan? Now, this was by far the most common question. It's like, it's interesting, but why should we care?
So repo is how you get to live to fight another day. Okay? So that's not my meme. That's, coming from Perry Merling.
Yeah.
But again, repo is how you get to live to fight another day. It's very important. What that means is you go to the overnight repo market because you run out of money. You can't make payments today, payments that are due today. So on the margin, you go and try to get some money so that you can make a payment today and you pay that money back tomorrow to someone. If you can't borrow in the repo market and you can't get the cash to make your payments today, you're not going to open up tomorrow. Okay, so if you are an RV fund that needs to roll funding on its position, if you are a primary dealer and you can't fund to roll your positions and top up your clearing account at your clearing bank, if you're a small dealer that can't fund, you're out of business tomorrow. So that is why you basically care about this stuff. It's like when you look at an electrocardiogram and the heart ticks, it ticks, and it doesn't tick and it starts to beep. So it's something like that. It either ticks or it doesn't tick. So it's existential. When you see these rates at 10%, it means that people are having a hard time getting the money to make payments. The U.S. Treasury is having a hard time pumping treasuries into the system on settlement days. The money is not moving to the Treasury general account because people are not willing to part with their money. In this case, the large banks run out of reserves. So the money ain't going to the U.S. Treasury. So quite frankly, if you need to pay unemployment insurance benefits and food stamps and all that stuff, the funding of that stuff process gets gummed up. So this is serious stuff. And, the reason why the Fed responds to these things quickly, they could have responded quicker, but the reason why they respond to it quickly is because, they just recognize the nature of these overnight markets where the money doesn't flow. People can't pay, and people can't pay. They go out of business. Headlines can happen, right? The good thing was that, this dislocation didn't last for more than a day. If these dislocations go on for 2 days, 3 days, a week, it can turn into an existential problem for a lot of people.
So another thing that I've been wondering, just on the idea of the Fed having to come in and sort of swoop in and fix this problem as soon as possible, although, as you point out, it could have been faster and they did have technical difficulties when they first tried to do it. How much of the confusion or the fact that repo rates actually got to 10%, how much of that do you think had to do with Simon Potter having recently left the New York Fed? Oh, and also, actually, I've always wondered this, but do you ever talk to the Fed about these issues? Do they, talk to you about your thoughts on this?
For the record, in 5 years, I've seen them once. 2 years ago, it was. On the other question, I don't think so. I think again, it's I guess the message would be that taper, I guess, was a mistake. So the difference between the repo market printing normally, like it has been for the past 5 years, versus the repo market falling apart on December 31st of last year, early September this year, is basically those $600 billion of reserves that were taken out of the system by taper. So if you look at the usage of the reverse repo facility, the other repo facility, right? That's the facility where money goes when that money is not needed because there's not enough collateral, people don't have the balance sheet, there's not enough arbitrage opportunities, so nobody takes the money from the money funds and then the money funds put it at the Fed and then money goes there to die. It is very important to kind of realize that taper started when the usage of that facility was zero. That means that, lazy cash in the system was already gone when taper started. So all these, taper and increase in treasuries cash balances, the increase in the foreign repo pool was basically taking money out of bank HQLA portfolios, these are liquidity portfolios of the banks, and it was taking reserves out of the portfolios of JP Morgan and all the other large American banks. So basically, in English, that means that taper was taking the liquidity buffer away from the system that basically ensured that these large banks have the extra cash to lend into periodic dislocations in the repo market and in the FX swap market and all sorts of other markets. So the fact that we engineered taper and we tapered as much as fast as we did without the safety valve built into the process where if, God forbid, we take out too much reserves, we should have a facility to kind of put as much liquidity back into the system as needed, right? And let the usage of that facility speak loud that taper should stop. We didn't do that. So back to your other question, I think the problem is that we tapered this much this fast. So it was kind of a architectural mistake. So personnel changes, I would say, have nothing to do with, the blowout and the response to that blowout the day of. I think it has to do more with why did we end up in this position in the first place. And by the way, when you listen to the Fed throughout the whole taper episode, when you read those speeches, the indicators that the Fed was looking at to see if things are getting tight or if we should stop taper were the wrong things to look at. The Fed was looking for banks' use of intraday credit for signs of stress to show up. Earlier on in the conversation, we said that there's no bank that is ever going to use intraday credit from the Fed post Basel III because it's not worth the reputational risk. Nobody wants to be the first one to use it. Nobody wants to be the first one to max out the lines. And if people were to use it, no one's going to be willing to kind of let those things fester and be rolled into the discount window. So basically, I think you had the wrong things they were looking at, and they tapered way too much, way too fast, and they put the system into a precarious position. And again, the conditions for what happened in the repo market in September were building over time as they were shrinking the balance sheet. So it's almost like a wildfire where you have all these dry leaves accumulate, and then something bad happens, and then the wildfire gets really bad because the dry leaves accumulated over the time.
You mentioned something there that speaks to the last time you appeared on our show, and that relates to the role of a foreign participant in the market. We just did an episode actually with Brad Setzer in which we talked about Taiwanese life insurers and their thirst for dollar-denominated assets. I think it was what we talked about. I think it was back in April or May was the last time we talked to you. And it was kind of about this topic and that as rates on dollar-denominated assets, particularly treasuries, were coming down, there was less appeal to hold U.S. government debt, and that it made more sense for foreign buyers to essentially just have money at the Federal Reserve and leaving all these treasuries on the dealer balance sheets. Talk to us about this aspect of the repo crunch. How much of it is essentially a result of what you were talking about when we talked to you in the spring about the fact that normally these foreign buyers would be in the government bond market, but when rates got too low, it just didn't make any sense. So why not just hold the money right at the Fed, exacerbating the reserve shortage?
Yeah, so, rate gets too low. And the other important thing is that the curve inverted, right?
Yeah.
So that's what we talked about last time. It has a lot to do with it, right? Because if you think about what the world used to look like 2-3 years ago when Japan and Taiwan and all those Asian accounts were buying more. I mean, they're still buying, but not as much, and definitely not enough relative to supply. The theme in the money markets back then was that, Asia is buying, they have to hedge it back to yen and, to euros and other currencies. And they typically do the 3-month point. So, buy a 10-year treasury, you hedge it back and roll those hedges every 3 months. So that's a pressure on 3-month funding costs. Now, LIBOR widened 60 basis points around money fund reform, which also coincided with that time in markets. Cross-currency bases between yen and dollars widened as much as 100 basis points. And very interestingly, The Fed didn't care one bit about the so-called OIS basis blowing out to 100 basis points between yen and dollars. In English, what that means basically that parity between term funding onshore and term dollar funding in Tokyo completely broke down. So people in Tokyo were paying 100 basis points over for dollars at the 3-month point than people onshore here in New York. That was kind of a big deal, but you had no speeches about it, no blogs, no papers, no nothing. When 3-month funding costs are stressed in the FX swap market, right? As a dealer, you can lend into that demand by borrowing at the 3-month point, also in the FX swap market, in unsecured markets, secured markets, or you can borrow not at the 3-month point, but at the 1-month point, the 1-week point, the overnight point. So the point here is that, the dominant bid for funding is at the 3-month point. The funding of that borrowing need can be distributed along a 3-month stretch in money markets, going from overnights to 3 months. So overnight markets are going to kind of feel this stuff, but only a part of it, a little part of it. When the curve gets inverted, okay, and as we discussed last time, all the carry traders get knocked away on the margin. So the foreign hedge buyer is not buying as much. The foreign banks are not buying as much. The RV hedge funds can't buy as much. There's one group of entities that has to buy by law. Those are the primary dealers. So the dealers started to back up with inventory. But the dealers are in the moving business. They are not in the carry business. So a dealer is never going to term fund its inventory. They tend to fund it overnight and roll it overnight. And here's the important point. When a dealer is the marginal buyer of treasuries and they fund things overnight, the only way you can fund that overnight funding demand is overnight. You can't go anywhere. You're not going to, fund an overnight funding demand with like the 3-month point because, if the Fed cuts, then you're in a bad position. So everything over the past year in fixed income markets, in money markets, was funded at the overnight point. And that's a dangerous situation because if the money doesn't come in, but it goes out, maybe because there's a large settlement day, maybe because there's a tax payment day, once the money goes away, you literally hit an air pocket. Okay, and if there is no one to lend into that air pocket, you have a problem. And the Fed cares deeply about where overnight rates print. So the overnight rates breaking down and those spreads widening out massively is a far bigger deal than 3-month cross-currency basis blowing out to 100 basis points. The inversion, dealers becoming the last bid for treasuries, everything happening overnight, which is the Fed's sensitive point, has a lot to do with everything that happened.
There's quite a lot of irony in this when you think about a lot of those post-crisis liquidity rules were basically aimed at improving fragilities in the repo market, right? And like strengthening the overnight funding market. And instead you seem to have ended up with a slightly opposite situation.
Well, you ended up with a slightly opposite situation because I think the other important thing that people tend to overlook is that the repo market has grown tremendously this year.
Is that because of treasury issuance or something else?
Well, partly treasury issuance, but also the growth of sponsored repo.
Right.
Sponsored repo, for those who don't live in the front end, is basically a new...
Including me, I don't know it.
Okay, so let's educate Joe a little bit here.
Thank you.
So sponsored repo is a new way of doing repo in that... Okay, so there's basically 3 banks for now that have the ability to do sponsored repo. And these are State Street, Boney, and JP Morgan. Sponsored repo, the idea is basically to let well-capitalized member banks, there's not dealers for now, banks of FICC to sponsor in money funds and sponsor in hedge funds into the repo market such that when you sponsor these entities in and you let them face off against each other through a matched book that you provide, you can net these positions so they don't use balance sheet. Okay, so this is basically a way for the system to provide more balance sheet and more liquidity into the repo market without using balance sheet, because balance sheet constraints is one of those things that Basel III is constraining. So all this treasury collateral coming into the system has, for the most part, been funded in the sponsored repo market. sponsored repo at the moment is only available on an overnight basis. So if you were an RV fund, or if you were whoever and you needed balance sheet in the repo
RV
market, the relative value fund, right? Well, and if you needed balance sheet in the repo market, it was only available to you overnight because term trades are not available in the sponsored repo space just yet. In addition to the things we discussed before, that dealers got backed up with the paper, they had to fund it overnight. It was also the case that the relative value hedge funds and whoever uses repo to fund treasuries could only do that overnight. So this kind of new piece of the market, sponsored repo, which has grown to something like $300 billion in size, also was a part of priming the system for a accident. Because again, if the money doesn't come in because it has to go someplace else, then basically a lot of long positions that are funded overnight can't get rolled. And that's precisely how you can end up with repo rates going from normal to 10% the next day.
All right, I want to get soon to the sort of how ultimately the Fed fixes this structural plumbing, what have you, issue. But before we do, I just want to go back to one key question that I recall coming up in the immediate wake of the Repo Madness. The big banks like JP Morgan, did they still have, technically speaking, excess reserves beyond their liquidity requirements?
The banks had reserves.
Yeah.
But those reserves were by no means excess.
Okay.
And this is what people tend to get lost on, right? So it is perfectly possible for the largest U.S. banks to sit on $100+ billion of reserves in their reserve accounts. And it's perfectly understandable why they don't lend
those
question. Reserves, right? Because they need those reserves to satisfy their intraday liquidity requirements. They need those reserves to be able to pass their resolution stress tests, things like that. Okay, so again, when you go to a bank that had $300 billion 2 years ago down to 100, and it wouldn't lend more in the repo market, the $200 billion was the excess, and all of that was spent, and whatever is left is not there to be played with. If you think about these reserves as high-powered money,
that
$100 billion that's there, that ain't high-powered money. That's dry powder that has to sit there and you can't use it. The 2 weeks before the repo blowout, I've seen, they are all clients of Credit Suisse, the bank portfolios. I've seen 4 of the largest bank portfolios. And you talk to the CIOs that run these portfolios, they will tell you that I would like to earn more with my cash. I would like to harvest the yields in treasury markets. I would like to harvest, yields in the GC market. But I can't, and currently I'm making uneconomic decisions with my reserves because I need to hold those for regulatory purposes. So that is basically the environment in which we are getting closer to this repo blowout. A lot of people, point their fingers at the bank saying, they were the ones who caused it because they have so much at the Fed. Why didn't they lend more? There's nothing that a bank would like to do more than to earn a 10% yield by moving all their cash into an overnight market and get that money back tomorrow and make 10%. So the fact that you have these yields has to do with just banks' inability to lend, not their willingness to lend.
Right. So this is sort of what I was getting at with the scarcity versus shortage of reserves earlier. There's this big arbitrage available in the market, free money basically, but the banks can't come in and do it. So just getting to solutions to this problem, we've seen the Fed increase overnight liquidity operations and also announce that I think it's going to buy up to 60 billion of T-bills, or did they increase it recently?
60 billion a month, yeah.
60 billion a month of T-bills. And yet there have been a couple of times this month where we have seen repo rates start to creep up again. And we've seen some analysts at the sell side, JP Morgan, Goldman Sachs, and Bank of America Merrill Lynch, also saying that they think the Fed hasn't done enough to solve the market problem. So what exactly is it that the Fed needs to do, and how big of a sort of problem in the repo market remains?
So I agree with the strategists at JP Morgan and Bank of America. I think as well that the Fed has not done enough. What we have is good for now, but it's not a structural fix. There's a big difference between, a liquidity problem and a a balance sheet problem. Okay, so, in September, we had a liquidity problem because the system ran out of reserves, the tokens you settle with. So the only thing the Fed had to do is just pump in reserves on the margin. The big event that's coming up is the year-end turn. And during year-end, no one is going to have the balance sheet to move money around. So, what I'm trying to say with that is, it's okay that the Fed has a repo facility, and for as long as there are primary dealers that are willing to take liquidity from that facility and broadcast that liquidity to the rest of the system, to the hedge funds and little dealers and whoever needs that money, the facility works. But once the primary dealers have a balance sheet constraint and they won't be the intermediary between the Fed and the rest of the system, it doesn't matter how much the Fed wants to put liquidity into the system with that repo facility. There's not going to be a mechanism through which they can inject that liquidity into the system. So like a very weird analogy here would be that, if I'd like to play tennis, but I don't have membership at the country club, you do, Joe.
Yeah.
I can go in with you.
It would be the exact opposite in real life, but
well, right. But if you're out taking a hike, there's no tennis for me because my friend who's got membership to the country club, cannot get me in. So you basically need someone to hold your hand to get that liquidity. And during year end, no one has the balance sheet and no one has the ability to be the good Samaritan who's going to take the liquidity from the Fed and give it to you.
So again, we've hit on this, but just to make it clear, quarter end, year end are important because there's a snapshot taken of the bank's financials, and it's literally on that day that the regulators take a look at the books, and everyone, it's like kind of cleaning your room before your parents get home, and
something like
that. So what is the solution then, such that we can avoid having these problems pop up every time that the parents come home to check out whether the room is cleaned? And do you expect that in the absence of something new, we are going to see something dramatic again reappear on the market over the next as we get close to year end?
Yeah. So there's a couple of things. Let's talk about repo first, and then we can go to the bill purchases. Fundamentally, the issue is that the repo operations that the Fed is doing, in technical lingo, it's done on a tri-party basis, so it cannot be netted. So that's how you get to the balance sheet problems. People say that the Fed should turn its repo facility into it's a standing repo facility effectively anyway, but I think what they really mean is that the Fed needs to make this repo facility nettable. I think that will never happen. It will never happen because the Fed, just by its DNA, they like to be super senior in their dealings. And there is no way that the Fed is ever going to lend into FICC, the Fixed Income Clearing Corporation. They are not going to lend into the into the clearinghouse and be a pari passu lender alongside everyone else. It's just not the way they do things. Two, if they were to do things in a super senior way, they would basically upset everyone in the clearinghouse because everybody just got subordinated to the largest lender in the clearinghouse. So I think it's either the Fed who's not going to do it because they're not comfortable with it, or they will do it in a way which is just going to set the stage for a massive coordination problem and just upsetting the governance of the Fixed Income Clearing Corporation, which again is the central clearinghouse for repo transactions. Not to mention other things like with this growth of sponsored repo, there is now, as we speak, about 25 hedge funds that now have access to FICC. So are we really going to go into a regime where hedge funds can put collateral into the clearinghouse and the Fed effectively on the margin is going to fund all that? So probably not. I don't think that we should go down that path. So that's one thing they could do, but they will never do, really. The second thing they could do is to open up this facility for banks as well as dealers. So this is a very important distinction. At the moment...
So non-primary dealers.
Well, no. So at the moment, it's the primary dealers that have access to this facility, but the banks do not. Okay, so just to give you a concrete example, let's say JP Morgan Securities as a primary dealer has access to the repo facility. JP Morgan Chase Bank NA, the depository, does not. So now if you go back to the earlier conversation we had, dealers got backed up with treasuries. They needed to get that funding in the repo market. And the banks, the bank portfolios were the marginal lenders in the repo market. Okay, so, and the reason why the money dried up in the repo market on the margin is because the banks hit their lowest level of reserves they need to hold. So they stopped lending despite the fact that they have all those reserves. You just can't go below it because you would be breaching your regulations. So what you could do is you could open up this facility for banks, and the chief regulator, who's Randall Quarles in the Fed, would have to give a speech saying, we are fine with large banks to have all bonds HQLA portfolios. This, $100-odd billion that is sitting at each of the large banks' HQLA portfolio can be spent to the last penny. It's okay for these largest banks to have bonds only in their HQLA portfolio because the Fed stands ready with a repo facility to turn those bonds into cash when intraday liquidity needs arise. And if there is a resolution scenario where the bank has to be wound down, and we will take those treasuries, give money in return, and let that money pay out its creditors and wind down in an orderly fashion. If that speech were to happen, and if that change to the philosophy with which the regulator would like to see the banks run their liquidity portfolio happens, and the banks get access to the repo facility, then you basically free up easily $500 to $600 billion of reserves. And that's $500 to $600 billion of extra money that can go into the treasury market and it can go into the repo market. Is that going to happen? Probably not, because you are not going to change the philosophy with which you run these liquidity portfolios just to get through this year-end turn that's coming up. A third thing you could do is you could put a footnote on the repo facility page of the New York Fed's website saying year-end is shaping up to be a very bad event. Let's just be clear that whatever money you will take from this facility going into that turn is going to be nettable. So from a regulatory perspective, you're just not going to have to count that in your leverage ratio and all these things. So, if I'm a dealer and I go to this facility, I take $50 billion and I pass it on. I mean, the Fed knows exactly how much I took, and it knows exactly how much balance sheet to ignore from my calculation. Is that going to happen? I don't know. I mean, a couple of the dealers that are primary dealers run their repo books out of branches. Those branches roll up to the holding company in their respective countries for reporting purposes. So can the Fed guarantee that the French regulator and the Japanese regulator is going to have the same view on what's nettable and what's nettable? I don't know. So I think it's kind of a coordination problem. So I don't think that any of those things will happen. And if none of these things happen, you basically set the stage for something quite ugly happening around the year-end turn, because it's not going to be just a liquidity problem, right? The people are not going to have the balance sheet to take the liquidity that the Fed is trying to put into the system. And the market can really get seized up. So if you thought September was bad,
oh man,
December can get even worse. But then again, you see headlines, Treasury Secretary is looking into ways of dealing, with some of the regs, and maybe some changes coming from the regulatory side. You just don't know, So if something big is going to come, then year-end is less of an issue. If none of those things will come, year-end is an issue.
Right. So you can imagine that any tweaking of the existing regulation, there's an optics problem there, which is that a bunch of people will say that you're basically rolling back bank regulation. And in fact, we've seen, people like Elizabeth Warren actually start talking about repo markets and what Jamie Dimon over at JP Morgan was saying. I have one more question, and you sort of alluded to it just then, but we've been talking about the repo market sort of in isolation, although, as you say, it is a very, very big deal for markets overall. But is there a specific scenario in which a gumming up in repo, another bout of repo madness, maybe one that's worse at the year end, is there a scenario in which that impacts risk asset exposure at the primary dealers or the banks or big market participants as well.
Oh, definitely. In fact, you've seen a micro tremor in September, and it's hard to see it, but if you talk to the equity desk at a dealer, they will tell you that this happened. So what happened in September when repo blew out, the equities that the street was the most long in sold off, and the equities that the street was most short in rallied. So what that tells you is that the balance sheet that the equity derivatives desks and cash equity desks are providing to the street, the longs were trimmed because there was no balance sheet for them, and the shorts were trimmed and because there was no balance sheet for them, right? So that's what caused those moves. And what happened was that at some dealers, and it's not all dealers work like this, but there are some dealers where equity derivatives and FX forwards and repo basically rolls up to a single person. So you shift equity across these businesses based on where the spreads are the richest. So in September, when repo blew out, there were some dealers that took balance sheet away from equity derivatives and the FX desk and moved it to the repo desk because you wanted to harvest those wide spreads to the extent possible. And as you moved that equity and you took balance sheet from equities away, there was an impact on equity markets. The reason why this didn't get out of hand and it didn't start to impact more names and didn't last for longer is because the Fed stepped in, started to lend in the repo market, and the repo market calmed down. So whatever equity you shifted there went back to the equity desk. So again, if this thing persists, and this is just a spillover into risk assets, but if this thing persists, remember that repo is how you get to live to fight another day. If you have to fund at 10% for a day, another day, and a third day, it can become existential.
Yeah.
To the point where you end up with headlines in newspapers, front page, So that can also spill over into risk assets. So I think there is a very real chance that if we don't have a better set of pipes from the Fed and a more aggressive QE, then you have a very, very problematic year on turn.
You just opened up the, and we don't have time to go there because you just opened up the most controversial Pandora's box of whether this should even count as, whether this is QE or not QE, and I feel like we could do a whole separate discussion on that. Unfortunately, I don't think we have the time, but I think that was a great, leaving us with that potentially gloomy note of maybe a bigger Repo Madness coming in December and one that potentially spills over into risk assets, something to, I wouldn't exactly say look forward to, but something for everyone to pay attention to.
Something to be aware of.
And I think after this discussion, hopefully people have a much deeper understanding of what's really going on. So Zoltan, it's so great to talk to you. Thanks for coming on.
Thank you very much.
Thanks, Zoltan. That was so good. Joe, you know what I love about that conversation is that Zoltan sort of brings these big picture theoretical approaches to everything that we've just seen in the repo market, but he also gives you the sort of technical behind the scenes look with what is actually happening at some of these desks and the primary dealers. So I really like that.
No, I think this is incredibly important. And it's kind of touched on what we talked about last time, but in a more specific way, that it's easy to say, look at some charts and say, oh, this bank should have excess reserves and this is just a plumbing issue and so forth. But then you get into these very specific scenarios in which people who are running portfolios or people who have to figure out how they're going to provision their own liquidity may move money or may decide to move money from one activity to another. And it's very real world. It's not just a series of cells on a spreadsheet that should behave in some predictable pattern.
Right. Well, I also think, people hear money markets and Repo Madness, and they think this was a really technical issue in the plumbing of the financial system, as people always put it. But actually, a lot of it is behavioral, sort of on both sides. So you have People who, for instance, don't want to access the discount window because it's seen to be a bad thing post-crisis. And then on the regulatory and political side, you have people who probably are unwilling to really tackle this issue because of the optics involved, right? You don't want to be seen to be bailing out banks or rolling back financial regulation, even though, logically, there seems to be something slightly off with the system.
Or even, as he described, the Fed's own posture of not wanting to be subordinate, or other entities that want to lend into this market, not wanting to compete with the Federal Reserve. All kinds of questions that, again, on paper or on Twitter, someone might be able to, the Fed just needs to do X, set up a standing repo facility. Why haven't they done that already? I thought I learned a lot from that conversation about why it's not quite so simple as just setting up a new desk where anyone can swap treasuries for reserves and have the liquidity they need for regulators.
Yes, indeed. And now, of course, we'll all be watching out for what happens at the year end if we weren't doing so already. So we'll have to have Zoltan back on in the new year too.
Yeah. I actually thought I was like, oh, okay, they're never going to let this happen again because we saw this and we know that the year end is already stressful. So I'm a little disconcerted about how concerned Zoltan is for the year. And one other point that I really liked, and I think it's to get the language across here, and this idea, and he used the term several times, tokens, to describe reserves. And it's a good reminder that money, while they may, there are many different forms of the dollar, and they basically trade at 1-to-1 all the time, they're not completely fungible.
Right.
And so you think about a casino, and you have $1 and you have a $1 token, or a token worth $1. And in theory, they're pegged perfectly and they always trade, but it doesn't mean you can't have an issue, or that the poker players who want to leave wouldn't be really upset if there was some issue with just the mechanics of the conversion. Even if, say, the casino owner had plenty of money and they could make good for everyone, you could get these sort of very technical, angry situations, stressful moments if there were a token shortage or something else. And that really sort of speaks to the issue that there are all these different forms of the dollar. But if there's a shortage of one, you could still have, or if there's a temporary shortage in the provision of one, you could still have these issues. So I think the language he used there is extremely helpful in that understanding.
Yeah, it's sort of like, I guess, liquidity everywhere, but not a drop to drink kind of thing, right? The system's awash in liquidity, but that doesn't necessarily mean that you can move it from one entity to the other. So
if your regulator wants you to have one very specific type of liquidity, because again, treasury bills 3-month are among the most liquid, safest, most valuable assets in the world. And if even they're not good enough under certain sort of regulatory demands, you get these bizarre situations in which highly liquid, well-capitalized banks could still find themselves with some sort of shortfall.